for the realtors? How's a realtor going to use this? Where's his borrower? How's he go and get borrowers for this?
And so what I would suggest they do, and part of that is, I did take off the sharing my screen, correct, Dan? All right, so the fact of the matter is investors are coming all the time. People are coming asking on how they can qualify without income. I don't have employment. I don't have the assets or the income stream to buy an investment property, but I'm cash flush. So in that case, is a lot of times what these investment properties will do is, they are required like a 20% down payment is basically the maximum LTV on these DSCR files at this point. I would expect those to increase sometime over the next, 3 to 6 months again. They used to go up to 85% LTV, 90% LTV, but they're really driven for those customers that are cash flush and looking to either start or expand their real estate investment portfolio. There's a ton of borrowers out there right now that do have that, but they don't like to supply their tax returns, things of that nature. In that case, as long as we have 30 to 60 days worth of assets, I think that's the best way to drive that investment purchase or the investment borrowers, seeking those out there.
So how many units can you go up to with this?
So we allow for a 2 to 4 unit on this. Okay. We are going to be expanding it. There's a lot of investors out there as well. Sure. Companies like my company that go up to 5 to 8 units. I do know that there's another one out there that will go up to 29 units and treat it as like a DSCR product. But right now we are 2 to 4, and we'll probably be pushing that 5 to 8 again within the next probably 3 to 6 months. It's gotten a little bit tighter over the last 3 to 6 months as the market has changed, obviously. So I think you're going to see that. But the higher the units, sometimes what they're going to do is they're going to reduce the LTV a little bit, maybe by 5%. Okay. It's not extravagant.
Homes that are out there, maybe, 2 units. Could this be used for like a first-time home buyer or somebody who's right out of the gate looking to invest, to maybe purchase a home and have that second unit pay for their mortgage?
And that's a great question. Thank you for that, Karen. Thank you for leading that. It cannot be used as a primary residence. So if you are using, if you have, for that example, you have a duplex and the person is going to live in one side of it, that is covered by TRID, and because it's a primary residence of that borrower, that wouldn't be able to fit into the DSCR loans because that needs to be TRID compliant because it's a primary residence.
Okay, but could they actually do this without a history of having any investment properties?
They can. Now they do have to. Your current borrowers or your new borrowers do have to have a primary residence, and that it's gotten a little tighter recently. Again, when the market changed, the problem with that was a lot of people were renting, and they were buying these properties DSCR with just cash and not qualifying any income, and they were actually living there. So it was basically a no doc loan, and investors got smart, right? So they decided to take that away. The borrowers now have to have a primary residence. They can be first-time investors. Those requirements are a little bit more stringent. Sometimes maybe a 5% LTV reduction in a 680 FICO, for example. They're a little bit tighter guidelines, but they absolutely can get in there.
And how would you?
So just to clarify though, as Nexa is a big broker, right? We have 200 lenders. We do have lenders that do allow them to, it could be their first time buyer, or they could be a first time buyer as long as they have current rental history. So,
if they're not that first time investor, right?
Yeah.
Right.
Yep. So and again, I can speak intelligently and semi-intelligently probably on what we have to offer.
Yeah.
But you're absolutely right, Dan. I know that there's some companies out there that are still doing those aggressive programs, which is great. I mean, it's definitely a great way to get people's feet in the door as far as that investment in real estate. There's a ton of people that are talking right now that this is the best time to buy in the market, even though rates are high. Smart investors and people that have that that willingness to put a little bit of risk in the game, this is where they make their money. This is traditionally over the last 100 years. This is where people make their money is investing when others. Good piece of that is what type of properties are available. I could share that and let you know what properties are eligible. And again, as Dan said, our eligibility might be a little bit different than some of the other 200 lenders that Nexa works with. That is a huge benefit of working with Nexa. They have so many different avenues that they can place people. Best organization in the nation as far as I'm concerned. And they just have that ability to do it. So, typically, yeah, no, I mean, it's great. I mean, your support systems like this are excellent, giving us the ability to kind of discuss this is awesome. So, typically we like to, some of the easiest ones are, single family residences, 2 to 4 units, condominiums. We do, and most lenders will do warrantable and non-warrantable condos. The deck that I'll be able to provide you will show some of the qualifying non-warrantable condos. The questions that I get a lot, what constitutes the non-warrantable and what kind of files will you be able to do as a non-warrantable. So you can definitely take a look at that. Qualifying is relatively easy, and these are a little bit looser guidelines. And the one thing I can tell you is, the DSCR coverage, it's basically that 1-to-1, so if it's covered by the income produced by the property and it covers the PITIA, the principal, interest, taxes, and insurance, you should be good to go. But there are programs like every investor that Nexa works with, they can go under a 1-to-1 ratio as well. And your strong investors understand that. They anticipate rates, falling again probably in another 6 months. There's some great, I'm definitely not an economist, but they expect rates to kind of go down first quarter to middle part of next year, giving them the opportunity to refinance at that point and make their investments a little bit more cash worthy. But this is the time that people are making money.
Political and the rental income itself. Are you guys allowing Airbnb income, or are you doing a 1004D or whatever?
1007. The 1007. And again, thank you for that.
I was so close.
You are very close. 3 numbers off. It's all good. So we do. So every file on a purchase will require the 1004 to determine the value of the property, right? And then we're going to require what's called the 1007 or the fair market rent schedule on that property. That will actually devise what the long-term rents are for that property. And that's traditionally how they will factor the debt service cover ratio. Now, that does not mean that we do not do short-term rentals. We can absolutely do short-term rentals. This is a great for the real estate industry. If you have a seller that is currently selling the property and it was a short-term rental, VRBO, Airbnb for the last 12 months, if that seller is willing to provide us that look back over 12 months, we can use that income to actually substantiate the debt service cover ratio of the property. And a lot of times that's exponentially higher. Right. I've seen it 200-300% higher than what the actual fair market rents are.
Right.
If you don't have that look back, Dan, then you would be required to have that fair market rental, the survey, cover what those rents are. And again, that's just our guidelines. Some other people may be a little bit more aggressive in that, but that's traditionally what I've seen in the past.
So if on a purchase, for example, obviously the buyer's not going to have that 12-month look back. If an appraiser can gather that data, would that be acceptable?
No, because they won't use the Airbnb. Now they can substantiate that by getting other comparables out there. But again, we are actually looking at that property specifically. Sure. Yeah. So again, if they're able to uncover that from the actual seller, and that has been a property, an income-producing property as a short-term rental for 12 months, that's how we'd have to gain that information. Okay.
Fair enough.
Yep. Yeah. So, I mean, it's again, so short-term, single-family residence, 2 to 4 units. The items that we aren't seeing is condo tells. I think we are going to start to see that kind of get back into play again. Rural properties are not highly looked at for us anyways. We do have a couple specific programs, but you might see LTV reductions. Condos are very popular, specifically on the coasts that we do a lot of lending with. Manufactured homes. Again, I don't know about your other lenders, Dan, but manufactured homes and mobile homes, typically we like to stay away from on the DSCR product. It's just not something that has been prevalent, but it might be coming through.
I will say we do have an investor that will do a manufactured on this. So.
Yep. No, and I knew you did. Like I said, I think
It's
at
crazy
some point,
to me to think about it, but
Well, again, that's why I think people partner with Nexa, because you have those avenues. I mean, that's just a strong partner.
Todd, Shane had a question and said, can the borrower be an LLC?
Absolutely. So that is one of the biggest substantiating facts in this case. A lot of people will close in an LLC. We do only allow, and again, I'm shooting our guidelines. Typically, an LLC can have a max of four members in the LLC, and we do require the credit being pulled from every person in the LLC, so the application has to be drawn by all members of the LLC, but we do allow that to be closed in the LLC. One of the differentiators, and Shane, hopefully this kind of answers a little bit more of the question, we don't report that on credit either. If they're a lot of other lenders, even though they're closing in an LLC, they're still going to report to their personal credit. We don't handle it that way, which could be a differentiating factor for us. I've been getting that question a lot. So it wouldn't be actually reported to the personal credit. But that's a great question. Thank you for the ask.
Absolutely. And Guadalupe has a question. How is rental income calculated?
The rental income is calculated by several different things. Again, the main thing is that 1007 of the fair market rent schedule. The appraiser is actually going to do a comparison approach, just like you do on the 1004 to determine the value of the property. They're going to look for other rentals, basically the same square footage, same bed count, same bath count, and what they're currently renting for in that area.
So it's pretty much the same as doing comps.
Exactly.
Single family. Okay.
Exactly.
Now, if the borrower has a current lease agreement, is that acceptable?
Yep, but then we're probably talking a rental, or a refinance, right? Because they wouldn't have one. Now, if the seller has a lease in play, that it's going to be state specific, because sometimes those leases don't always carry through. They like to see that 12-month lease on it. Now, because they can increase a lease, they can decrease a lease. You got to be careful with that. Again, that's where they're going to look at that fair market rentals income. Now, we can look at if they have a fair market rental and say it's a $2,000 rental on that, and then the seller has leases for $2,300. There's case by cases that we'll take that $2,300 to do the comparison to see if the DSCR coverage is actually 1-to-1. If not, I shouldn't say if not, but we can use that, right? Because it's not extravagantly higher. Where they start to have problems is if the fair market rental schedule comes in at $2,000 and the leases that are provided are $5,000. Well, then it's a little bit different, and there needs to be a little bit more qualification on that.
Right, Nick. We had another question out there from Nick. Did that answer your question? You asked, if the property is vacant, how is the rent determined? And can I, as a realtor, look into the area to estimate? Which I believe you just said it's basically the same thing as doing comps for a single family.
Just looking at rental properties on MLS, right?
Yep, you're going to go at the fair market rental schedule. Probably 50 to 60% of the deals I see in a purchase are vacant, because either people bought at them and rehabbed. Maybe it was a fix and flip and they're throwing it into a main. However it might be, a lot of those are vacant, but that's where the 1007 and the fair market rental schedule comes into play.
Gotcha. And Guadalupe has another question. She said, do we use 75% of their rental income?
Nope. You use 100% of the fair market rental schedule. So if that rental schedule comes in at $2,000, you're going to use $2,000 to qualify that income. It's not like a conventional deal where you have to use 75%. These are 100% of that 1007.
Okay.
It's a great question. Thank you.
Yeah, Nick has another question. Let's see here. If this is a 4-unit building that has one commercial space for rent and 3 residential spaces, rental spaces, is it a mixed use, or is that something that you could do?
That would be considered a mixed use. At this point, we aren't doing mixed uses. Again, I know Nexa has partners that do mixed uses. I do anticipate that coming back for us as well. Just a lot of investors kind of backed out of that type of thing, you know, in the last couple of months, rightfully so. Well, I don't like rightfully so. I want it back, but so there are avenues for that, Nick. You know, in our case, now on a condo side, that could be a non-warrantable side, just so you know. So I mean, if and I want to allude to that. So if the condo space has more than 50% commercial use on the bottom, then it's storefront, you know, a lot of storefronts on the bottom. If it's more than 50%, we probably wouldn't be able to do that as a non-warrantable. If it's under 50%, you can. So there's some caveats to that, but traditionally that would be a mixed use.